Hi, everyone, and thank you all for joining today's meetup. Today, we are unpacking how banks can grow their non-interest revenue through customer interactions. I am leading today's topic. It's more of a discussion. The banking industry and how banks make money is a topic that's particularly interesting. So I'm quite excited to actually talk about this. If there are any questions or comments, please feel free to raise your hand, or if you prefer, you can drop them in the chat. I think Christina is monitoring the chat throughout this discussion, and we can pause and then talk about it. I'm going to kind of get into it. So for just a bit of a breakdown or an outline of what I'm going to talk about today, I'm first going to look at essentially very briefly what is non-interest revenue and the different income streams or different business models for how a bank makes money, and then why there is this major shift away from kind of prioritizing net interest income to prioritizing your non-interest revenue or the bank's non-interest revenue. I'm also then going to look at what are the different revenue streams associated with your non-interest revenue. Then we'll move into what exactly banks need to focus on it from a customer perspective in order to grow these revenue streams. We'll look at what an engaged customer looks like, and then finally I'll unpack how banks can use spend and money personality to kind of grow and improve their customer engagement, obviously with the aim of growing their non-interest revenue. So to begin with, I want to look at the two major ways that banks make money. The first one being I think it's something we're all fairly familiar with, which is their net interest income. This is something that will appear on their statement. I want to say their income statement. Any annual report will talk about the bank's net interest income. And the way that a bank makes money here is something that we were all taught in school, which is essentially a lender will deposit their money, maybe into a savings account. So all of us here probably deposit our money into a bank, and then the bank will pay us interest. The bank then takes our money and lends it to borrowers, and they make borrowers pay them back even more interest. So the key thing here, which is any basic kind of profit or kind of business principle for how you make a profit, is that you need to sell something for more than what you bought it for, or for more than what it costs you to make or produce. And in this instance, the bank buys money from depositors for cheaper than what they sell it for. So they sell their money to borrowers for a lot more than what they buy it for, and that's the interest rate. Now, this sounds fairly straightforward, but in reality, it never really is. And there are a lot of regulatory and capital constraints that obviously complicate this entire process. The next thing that I want to look at is the other revenue stream, which is what we're talking about today, which is their non-interest revenue. So we've got their net interest income, their NII, and then their non-interest revenue. But your NIR for a bank essentially refers to the money that the bank earns from fees, commission, service charges, or any form of income that is not from loan interest. And essentially this helps banks diversify their income. And the different revenue streams associated with this include things like your account fees. So we all probably have an account with a bank, and we often pay a monthly maintenance fee. And then depending on how many accounts you have, you'll probably pay multiple account maintenance fees. This can also include fees for international transfers, or if you own a foreign exchange account, you'll also pay fees for that. If you adopt or use any premium banking services, you'll pay a higher fee in those instances. Then there's also payments and transaction revenue. This is payments or payment income from payments is probably one of the most important capital light or revenue streams within the non-interest revenue stream of a bank. So this is essentially when anytime a customer makes a purchase, whether it's with a debit card or a credit card, or even their digital wallet, or they make a transfer, there are multiple participants involved in that entire ecosystem, and they all typically pay a fee to the bank. So if you tap with your card, you tap at a store, obviously there's a person with the card machine, that money then goes into the business account and then gets transferred to the other account. There's so many steps in place, and through each step, there's often a fee that gets deducted, merchant acquiring fees, processing fees, and then sometimes even foreign exchange fees. We then also have retail partnerships. So for a lot more sophisticated and I think modern banks, they often act as kind of this like digital ecosystem, typically through their apps. And a lot of retailers will then pay to access the bank's customer base. So you can often, I know on my banking app, you can buy data, airtime, gift vouchers for, I think like this Net Florist is on there. So you can buy vouchers for flowers, lotto vouchers. But yeah, there's all these retail partnerships that the bank will then kind of facilitate. And using their banking app, then retailers can access the customer base, and through that, they will then kind of charge a commission or a referral fee, and then that's another way that the bank earns money. We then also have services like wealth management. So anytime a bank manages a customer's assets, be it a unit trust or maybe a structured investment or a retirement product, they will typically earn a percentage of the amount that they manage. Sometimes there's advisory services that are offered. The customer takes up those advisory services, then they also pay a fee. We then have insurance distribution. Instead of banks underwriting insurance, they can also act as an insurance distributor. And in those instances, they also earn commission and fees, and you then get commission. So there's essentially this entire banking ecosystem where a bank can earn, money from different streams, whether it's account fees, your traditional banking services like accounts, cards, payments, and transfers, but then also these kind of separate offerings such as insurance and merchant retail offerings, things like that. So there's these different streams. But what's important, what I want to talk about here now, is that a lot of banks historically prioritize net interest income as their main source of profit and income. But we are now seeing a shift towards focusing on what's known as a capital light approach, and an approach where their business model prioritizes their non-interest revenue. And there are multiple reasons for this. So if we look kind of historically or in a traditional sense, why net interest income was viewed as a kind of engine of a bank's profitability, it was because the model seemed fairly simple. You buy money from depositors at one rate, and then you sell it to borrowers at a higher rate, and then you earn the difference. And the view was that the larger your balance sheet or the larger your loan book was, the greater potential there was for profit. But it has since become, over the past few years, there's been a lot of financial, regulatory, and capital constraints and requirements that have been introduced that have complicated and made this kind of fairly straightforward business model not as profitable. So the main thing that I want to talk about here that's often mentioned is something known as your regulatory capital, or some term that I've seen used is your cost of capital. And what this is essentially is the bank's financial shock absorber. It's the money that the bank has to keep set aside anytime it issues loans to absorb the shock if someone doesn't pay back those loans. So when a market experiences stress and people who have borrowed money can't necessarily pay back that money, the bank needs to have money set aside to ensure that they can absorb those losses and still remain a financially stable and sound institute. The problem with that is, when you have money just sitting aside, that is kind of kept for safety purposes, it's not necessarily being used to grow the business or being used to make more money. And one of those things that I want to look at is something known as their risk-weighted assets. And the idea behind this is that not all loans are essentially considered equally risky by regulators. So a mortgage loan or a home loan for a high-income customer is considered less risky than an unsecured personal loan. And because of this, there are these different risk profiles for different loans. Regulators then assign different weights to different assets. And because of these different weights to different assets, some loans will have to have a higher percentage of money kept aside for that specific loan because it's viewed as more risky, whereas other loans won't. So if there's any questions with regards to that and how I explain that, please stop and ask. But essentially, the riskier loan, the more regulatory capital has to be kept aside and held against that loan. And the reason that this is a bit of a problem is because there may be a high-risk loan that generates higher interest income, in the sense that there's more interest, the bank can earn more interest on this loan. But because it's considered riskier, they have to set aside more capital, and it then consumes a lot more of that regulatory capital that has to be kept aside to absorb those losses. So even though the bank wants to focus on earning more interest, they have to consider how they're officially going to use that limited capital that they have to set aside. And they want to keep as little of that capital set aside as possible because they need that money to make money. So as a result, lending activities that seem profitable on the surface aren't necessarily as profitable as they appear. We then also have credit losses, and basic idea here is that you have to account for the fact that someone's not going to pay back their loan, and if the bank is lending money, someone's not going to pay a bank back, they're essentially losing money. And I know for a lot of modern accounting standards, banks need to recognize those future losses before they occur. So this means that a portion of their lending revenue is immediately offset for future defaults. So they just kind of accept we've predicted or we've estimated that these are our future losses and this is how much money we're going to lose from these losses. Then lastly, in terms of other kind of regulatory constraints and requirements, we have something known as their liquidity requirements. So after the 2008 financial crisis, regulators recognized that many banks failed or collapsed because they ran out of liquidity, not necessarily capital. And there's a bit of a difference here. So banks set aside capital to cover their losses, but capital and liquidity aren't necessarily the same thing. Liquidity is how quickly that capital can be converted into cash to pay back people or pay back customers who have deposited their money. So as a result, to ensure that the bank can pay back those customers and can remain stable, there is now, it's a liquidity coverage ratio, and you have to essentially hold enough high quality liquid assets to survive a 30-day stress scenario. And these liquid assets include cash, central bank reserves, and government bonds. And the reason that's a bit of a problem is because these assets, these high liquid assets, generate lower returns. So this is even more money that's now being set aside that isn't earning the bank money, and it's not being reinvested, and it's not helping the business or the bank grow. So as we can see here, there are so many elements at play when it comes to a bank just issuing loans and wanting to make money through interest. There are liquidity constraints, regulatory capital, and obviously the fact that some people aren't going to pay back their loans that just complicate this whole process and make the idea that the bigger your balance sheet or the bigger your loan book is, more profitable you are. It makes this kind of not as obvious or as clear. It doesn't necessarily, just because you have a bigger loan book, doesn't necessarily mean you are a lot more or a more profitable bank. Now, I find that section particularly interesting, but obviously we want to get to the heart of this conversation, which is customer interactions and looking at how that plays a role in growing your non-interest revenue. But before I jump straight into that, I quickly want to go through another element that's contributing to the shift towards banks focusing on their non-interest revenue and growing that stream of revenue. And that is the role of challenger banks and fintechs. So historically, obviously, banks assume that the balance sheet or their loan book was their most valuable asset that they owned. And if you controlled deposits and loans, so if you had people depositing money and you were lending that money out to people, your borrowers, you then controlled the customer. They typically believe that that was a customer relationship. But a lot of challenger banks and fintechs that have arisen kind of disrupted this. And they came in with the view that owning, loans and deposits doesn't necessarily mean that you own the customer. They saw the customer relationship and the customer experience a lot more valuable than the balance sheet itself. So if we look at companies like PayPal and Stripe, they focused on owning the customer relationship by improving the customer experience, specifically the kind of convenience of the experience, of a singular experience. And we'll look at PayPal now. So they looked at, creating a convenient customer experience as a way to own the customer, and then monetizing that experience without necessarily having to go through all the regulatory and capital constraints that traditional banks have to go through. So, for example, if we look at PayPal, for the purpose of this presentation, I'm using them as my example. They made the payment process a whole lot easier for customers. So traditionally, even today, you have to obviously put in your card details when you're checking out online. When you want to buy something online and make a purchase, you've got to put in your card details, which was quite timely. And there were a lot of abandoned baskets because the whole checkout process was just too difficult. PayPal obviously made that a lot easier. And what I saw was you open up an account with PayPal, you link your card, you then, when you're checking out, you say click with PayPal or pay with PayPal. And then all you do is log in and you click confirm. And that just made the whole payment process so much easier. So not only did PayPal take, a singular process, they made it a lot more convenient and enjoyable for the customer. Through that, they then own the customer relationship. What was interesting as well is that they never charge their customers. They charge merchants, and the merchants then pay a fee when a customer uses PayPal to pay. So the reason that the merchants pay PayPal is because the whole checkout process became easier, there were fewer abandoned baskets. So it was beneficial for digital retailers and merchants. So what we see here is that because PayPal own this kind of one singular customer experience, they could then monetize that process and own the relationship without necessarily dealing with all these capital requirements of being a bank. And this is where we then see the shift towards owning the customer experience and relationship become far more important, because profitability for a bank now isn't necessarily dictated just by the balance sheet anymore. Owning the customer is about, who is the most engaged and who interacts with you the most, who has multiple bank cards, multiple accounts, who regularly interacts with your app. Yeah, who is essentially the most engaged. That is the customer. That's what it means to own the customer. It's not just about the balance sheet. And that process and monetizing that aspect of the relationship, those different experiences, is so important to growing your non-interest revenue, and which is essentially what we'll get into now. So to summarize everything that we've looked at now, we've unpacked, your non-interest income, your net interest revenue. We've then looked at all the regulatory and capital constraints that make it very difficult for a bank to earn profit, and it's not as profitable as it once was. And with challenger banks, we now see that a lot of banks are turning towards non-interest revenue and owning the customer experience as a way to grow their non-interest revenue. So the question then is, well, how can banks grow their non-interest revenue? And to answer that, we essentially have to turn to the customer and ask, how can the bank own the customer? How do they own the experience? How do they keep the customer interacting and then keep them engaged so that they are monetizing all these different avenues or different revenue streams, such as transaction fees, account fees, wealth management, insurance, and merchant fees? So when I unpacked the different revenue streams or the non-interest revenue streams, I looked at obviously account fees, payment fees, wealth management, insurance, and merchant fees. But to get money or to monetize and get fees and commission from these different revenue streams, there needs to be a level of customer engagement or activity and interactions that the customer needs to partake in for the bank to get money. So for example, if you want account fees, the customer needs to have an account, preferably multiple. If you need payment fees or transaction fees, the customer needs to be spending on their cards. You want them tapping fairly regularly. If you want them buying through your app, you need regular app visits. You need them exploring the app. If you want them opening up an investment account, you need to know which investment account to suggest. And you also want them making regular contributions. If you earn a percentage of how much money or how much money you manage or how many assets you manage for that customer, if you earn a percentage of that, you want them making regular contributions. So to get to that point where a customer is transacting fairly regularly, they have multiple accounts, they're making regular contributions, they're buying data, they've bought insurance, they've opened up a policy through the bank. To get them to do all of that, you need to know a fair amount about the customer. And what I mean by that is you essentially need to, if you want them to open up an account, you need to know which account to recommend, which financial products to recommend to the customer. If you want to encourage them to spend, and a lot of banks do this through rewards. If you spend on X card at X store, you get a certain amount of cash back. You need to know which rewards resonate with a specific company. If you want to nudge them towards a specific action, so they say they've been made aware of an account, you've recommended the right account, you now want them to onboard, open the account, get the card delivered, activate the card, use the card. There's a whole series of actions that you need the customer to take. You want to nudge them and guide them towards doing that. You need to know how to do that. In the case of merchant offers and products, you want to know which products from specific service providers to recommend. If you sell multiple telecommunication companies products, so for example data, if you sell data from Verizon and AT&T, you want to know which data bundles to recommend to which customers. You don't want to recommend a Verizon product to an AT&T customer. That's not going to go down particularly well. So there's all this information that you need to know, the bank needs to know about the customer in order to elicit these positive or interactions or get them to complete specific actions to then realize that profit or that gain. Now, the way to do that, how exactly do you know which financial products to recommend to a customer? How can you do that across a customer base of millions? That is particularly difficult. When we talk about private wealth clients, there's often a private banker and they have about 40 clients. It's It's difficult. You can come to know 40 people fairly easily, their needs, what products to recommend them, how to communicate with them, and you can grow a relationship with them. But if we're looking at mass retail, understanding a customer base across millions is not that straightforward. And that is essentially where our two tools come into play. The two that I'm looking at today are spend and money personality. And they essentially provide a way for banks to truly understand their customers at scale. So just in a nutshell, to look at spend personality, this essentially looks at how customers spend their money. And money personality essentially looks at how customers behave with their money overall. Are there any questions or comments? If there are no questions, that is absolutely perfect. I'm going to go back into spend and money personality. So to start off with looking at spend personality, what is it essentially and how does it work? So this is one of our algorithms that forms a broader part of our prediction platform, and it sits within a range of our solutions. And it is essentially, it uses AI and behavioral science to identify customers' spending habits and kind of curate this dynamic profile or persona. It assigns a spend personality score across 6 personality scores, 6 dimensions. And what's important here is that rather than putting customers into these fixed segments of, demographic-based segmentation, X age, X gender, X race, X income, they have, sometimes banks will segment their customers based on specific products. They have these 5 products, they earn X amount, so they sit in a high income tier. There's all these different ways that banks will segment their customers to understand them. But the problem with that is it doesn't actually tell us much about the customer beyond these surface level traits. It doesn't tell us how they behave, their values, their preferences, or their motivations. Whereas spend personality looks at or comes to identify the behavior within people's spending. And what's important as well is that it updates. So it can look at a person who they are now, not necessarily who they were yesterday, because our behaviors are bound to change with different life stages. But essentially, spend personality identifies or assigns a score to a customer across 6 personality dimensions. We've got intentional, industrious, experiential, enthusiastic, introvert, and extrovert. But to just give you a view of how the personalities kind of differ, intentional spenders, for example, they spend carefully and purposefully, and they kind of stay aligned to goals and values. Whereas someone like an experiential spender will spend on experiences and adventure. If we look at someone like an enthusiastic spender, they are typically socially driven participants and they thrive on connection. So these are just a few of the different personalities. But what's important is that they reveal kind of what motivates spending and how customers prefer to engage with products or services from their spending behavior. So we look at things like their transaction history, merchant categories, spending frequency, timing, locations, and these patterns over time to infer behavior and spending motivations. And what insight does that essentially provide? So instead of a bank saying customer A or customer 590, we often speak about customer 590 spends, $1,000 per month. Instead, through a behavioral score, the spend personality score, we then see the customer values, experiences, and they respond to travel-related offers. Obviously, it doesn't necessarily appear like that explicitly, but it's a score that provides a much richer customer profile beyond just income bracket, demographic status, and product bracket. We then also have money personality, and this is slightly different because, excuse me, it is a broader behavioral model. So where spend personality focuses on spending behavior, money personality kind of looks at the person's or the customer's overall relationship with money. And this includes spending, saving, borrowing, investing, risk behavior, as well as financial discipline. So we have 6 money personality types: carefree, indulger, adventurer, borrower, cautious, and conservative. A carefree personality type will show kind of inconsistent financial behavior with limited planning or control, whereas a conservative personality will prioritize saving and long-term security, and they focus essentially on spending on essentials. So what these personas and profiles do is help identify financial strengths, weaknesses, and motivations, as well as financial wellness needs. And it looks at things like your income patterns, saving behavior, your credit usage, spending habits, investment activity. And then it can classify customers according to how they manage their money using these 6 personality dimensions and assigning a score to a customer. So what insight does money personality provide? Similar to spend personality, instead of just saying, customer 590 has a savings account, we then see customer is cautious and they consistently save, they avoid debt, and they are likely interested in wealth building products. Or we may see this customer is an adventurer who spends heavily on travel and they respond better to flexible savings goals. So again, it comes up as a score. It's not necessarily, as I've said it, how it appears. But what's important here is that the real value within this tool is that it augments current segmentation approaches, where, as I've mentioned, we currently look at, or a lot of banks currently look at, those static profiles of demographics, product-based segmentation, income-based segmentation. This provides a better view of financial needs, motivations, and values, and allows banks to actually understand their customer beyond this surface level. Now, once you understand customers at a deeper level, you then begin to strengthen, customer relationships, because you can improve the customer experience in the sense that you make it more personalized. Every interaction that you then deliver with the customer becomes hyper-personalized. The whole point that I want to drive home here is that you deliver interactions that work for that customer. So if you are, an experiential customer and you value experiences, you are getting rewards and benefits or accounts or products, communication, whatever it may be, that resonates with those values and who you are as a spender, and it aligns with your money personality. So from this personalized experience, we then have that deeper level of customer engagement, and that then translates into that higher non-interest revenue. And I'm going to unpack a few applications just fairly broadly, because this isn't really a use case discussion, but there's different interactions that I've mentioned you want your customers doing, or different actions that you want them to take, whether it's activating a card, opening up an account, or tapping and using their card a lot more. Now that you understand the customer and how you can speak to them, you then improve that customer experience. You can deliver personalized interactions. You then get them opening up accounts, spending, interacting, opening up the app a lot more. And through that, you then begin to grow your non-interest revenue. So to look at just a few applications, I'm not going to go into too much detail. If we take the first one that I mentioned, which was banks for non-interest revenue, they typically rely on account fees. So if you want a customer to open up an account, you need to know which accounts to recommend. So the traditional approach typically looked at, age, 35, salary, $50,000 a year, and we want them to open up a savings account. But now if we adopt a behavioral approach using spend and money personality, we then see, okay, this customer is an experiential spender and they are an adventurous money personality. So we're not actually just going to recommend them a savings account, or if we are going to recommend them the same boring savings account that we recommend to everyone else, we're going to do it in a way that resonates with their values. We know they like to travel. We know they want flexible savings goals. So we're going to communicate via the app, and we're going to prioritize that this is a holiday savings account, or this is a travel savings account. If there are other financial products that we want to recommend to them, we notice that this person travels a lot. So as I've mentioned, they're an experiential spender and they're adventurous. We may want to recommend them travel insurance. And then that's an instance where we've recommended something within the bank's ecosystem of products and services. As I mentioned, insurance is another revenue stream within that non-interest revenue, where banks can earn commission and fees for acting as a distributor. So this is an instance where it's a good time to recommend a travel insurance product. Another point that I mentioned was transaction fees and payment fees. I often speak about credit card activation. So if you've been successful and you've made the right product recommendation to the customer, you've recommended a credit card, you now have issued the credit card and you want them to activate it. We then have a use case, which essentially looks at how do you push an activation nudge towards a specific customer when you understand their spend personality. How do you frame that message? Do you do it through a phone call? Do you do it through an app notification? We look at all these different channels. We look at the timing, when is the best time to recommend it to them, and then also the best language, so the tone. But some spend personalities don't respond well to being rushed. So saying buy now, or sign up today, or tap your card today, or activate now, and then exclamation marks. They respond better to thoughtful consideration and planning. So you want a message that speaks to them in a tone that is thoughtful and considered, and says, you have a card, think about it, it's best to activate it. But now you want them actively spending. And often if you want a customer spending on a card fairly regularly, banks will typically offer rewards. So you want to make sure you match the rewards to the customer. So if you're offering travel rewards, you want to match it to someone who travels fairly regularly. If an industrious spender prefers practical savings, maybe you want to offer them cash back that can then be transferred into their savings account. So those are the different rewards and ways you want to understand your customer to then match rewards to customers, to then get them spending on their card a lot more, to then increase that revenue generated through transaction fees. You want to know how to communicate that to each personality. So it can be the same product, travel rewards, but said completely differently in a completely different channel, different tone to each different spender. And then there's also, you want to know how to nudge customers, get them to complete onboarding. I've mentioned activating. There's other examples of, for example, airtime and data top-up. So I mentioned that service providers acting as a kind of a marketplace, a bank acting as a marketplace where they sell other services and products. If we look at something like airtime and data top-ups, you want to know which, as I mentioned earlier, which data products, which airtime products to recommend to a specific customer. You also want to be able to assess their kind of purchase frequency. So how often are they topping up? Are they buying every 28 days? You then want to be able to make a recommendation and say, you know, on day 26, running low on data, top up. But you also want to be able to communicate that in a way that resonates with that customer. Equally as important is if they've already topped up, you want to know not to send a recommendation to top up. So there's all these different ways that a bank can interact with their customer. But what's important to note is that interactions that are personalized, contextualized, and resonate with the customer are what keep that customer engaged and coming back. It's what keeps them tapping on their card, opening multiple accounts, visiting that app frequently. And through owning the customer in that regard, you then create more opportunity to grow your non-interest revenue. So, I mean, a few of the applications that I've unpacked now, we have unpacked previous ones in far greater detail. As I mentioned, the credit card activation use case. We'll unpack a lot more use cases in more detail moving forward. But looking at all these different use cases and different interactions, I really wanted to make the note here is that they seem quite small. You know, just getting customers to tap on their card or open up an account and paying a monthly account fee. It seems small at first, and personalizing that experience seems very small and insignificant for one customer. But when we look at it in the broader picture and we're looking at it across a customer base of millions, we see how these hyper-personalized interactions fit into the broader business model of a bank in terms of that driving that non-interest revenue and moving or kind of fitting in with that reprioritization of non-interest revenue over net interest income. I've discussed a lot here, so I'm going to kind of wrap it up and conclude, leave a few minutes for questions. But yeah, to conclude all of this, essentially, bank profitability, it is still profitable now, but historically, the engine and the primary driver of a bank's profitability was net interest income. The larger your balance sheet or your loan book was, the greater the opportunity to generate revenue and profit. But growing that loan book today comes with a lot of capital constraints, a lot of regulatory liquidity and risk requirements that make that balance sheet expansion quite difficult and increasingly expensive. At the same time, there are companies out there, your challenger banks, your fintechs, that have shown that you can own the customer without necessarily having to grow your balance sheet. They've shown that convenience, engagement, customer experience, owning that experience can generate a significant amount of revenue without the same difficulties that a traditional bank has to deal with. So as a result, then what we see is more banks are now having to go with the shift and adopt a capital light approach that prioritizes payments, transaction fees, account fees, merchant partnerships, acting, you know, as a kind of ecosystem and a digital marketplace, offering other services, wealth management, advisory, insurance, all of that. They have to now reprioritize and focus on all those different streams. But the success of those revenue streams really depends on one critical factor, and that is owning the customer and having that customer engaged. So the more engaged your customer is, the more likely they are to transact, open up multiple accounts, adopt additional products, purchase insurance, buy data, buy airtime, visit the app fairly regularly. Whatever it may be, you want that customer engaged. And though that level of engagement really drives these smaller interactions that then contribute to the broader picture of non-interest revenue. But owning the customer and owning that customer relationship or keeping that customer engaged across the customer base of millions is very difficult. And you need tools to help you do that. And that's where spend and money personality really play an amazing role in understanding or helping banks understand their customer at that deeper level beyond just demographics, income-based segmentation, or product-based segmentation. I feel like I've essentially summarized it, but that is the view of how banks can essentially unlock that sustainable growth in non-interest revenue. And yeah, focus on, I'd say the key takeaway here is that growing revenue now is about owning the customer, and owning the customer means understanding the customer. So yeah, thank you so much for joining me today. I'm going to drop the link to the spend personality and money personality website pages if anyone would like to go and take a look. If there are any questions or comments, go ahead. If not, I think we can close off. We have 2 questions. Joe, you were first, and then Gerard, you can go next.
Yeah, I'll put the camera on just for politeness, really. Excellent. Thank you. A fabulous discourse, very erudite and educational. I really loved it. I just wonder if you had, so it made me churn through some orthogonal patterns of, for example, I'm looking at, I don't know if you know of WeChat. WeChat is a Chinese app that originally started a bit like WhatsApp, but they have essentially every app that we segment and fragmentize in the Western world, like Uber or Grab for transport, banking, booking a ticket, shopping, just about every possible transaction that's got any kind of social interaction whatsoever or purchase is in WeChat. WeChat is essentially on the phone. Instead of having 18 apps, you have WeChat, and you can just do everything with WeChat, including plugging into banking services. So, I mean, it's a sort of Uber app of apps, if you like, right? And it's fabulous. It works all over China. It's just absolutely stunning. But the point where I'm going is they own the customers. They own all of the interactions. So if you want to go shopping, you go on WeChat. If you want to book a meal, you go on WeChat. You want to get a meal delivered, you get it on WeChat. Whatever you want to do is there. And so it's almost like an umbrella. Everybody owns the customer. There are apps running underneath it, of course, that are curated and plugged into WeChat, but it owns the customer. And I'm thinking of the banks now. If you look at what's happening in the banking world with Revolut and Monzo, for example, I don't know if you know Revolut. Revolut is beginning to be a banking version of WeChat. I know that sounds a bit ambitious, but I've been using it now for about 2 years. And they're getting better and better. Their mobile app is getting better and better. They're beginning to plug other services in. And it sounds to me that what you've got is an engine that can develop that kind of ecosystem. And I've just, doffed my hat. Brilliant.
Thank you. Thank you so much for that comment. Thank you, Joe. I can't say I have personal experience with Revolut, but I was just traveling now. And my brother said, next time you travel, open up a Revolut account. It's revolutionary because it's so easy to use. So that's as far as my experience goes. But if that's where these banks are going in terms of owning that customer experience, then 100% this acts as kind of an engine that helps Revolut and Monzo know their customer that level deeper.
Yeah, if I were you guys, I would reach out to Revolut and Monzo and, say, hey, look what I've got for you.
100%. Thank you for that. Gerard, yes, you are next.
Good afternoon. So I'm Gerard. I do strategy for one of the leading banks in South Africa. Yeah, thank you for the insights, right? I haven't gone through your dashboard in totality, but I can attest to one of the challenges we always have, and that is getting the full customer view, right? So we are on the journey of having and owning the customer and also designing all the product recommendations around the particular customer and getting our model to learn the customer a little bit better. But the challenge is always owning the customer completely. But also my question to you is, there's the bank view, which is this customer transacts. We are aware of the transactions of what they do, right? But then the challenge will always be, what is the overall market view of this customer, right? What I mean by that is, for example, in our bank, the person might only be transacting or buying insurance, etc., as you mentioned, right? But they buy airtime and data directly from the supplier. So we won't know that, right? If they don't buy through our platform, so we want to create recommendations and nudges, but we want to have a holistic view of this customer so that we can actually zero into, the overall market behavior, and also sell our products by knowing the full view of the customer. So it's always a challenge. So you find that these guys have bank accounts for different, everywhere. So they do different things. So it's always a challenge knowing, understand. So that's the challenge that we have.
So
Yeah.
I think, do you know who I had to say is best to answer this question is Jay, but he's not here at the moment. But I can draw back to one example that he always gives. And he was saying, if, we all know in South Africa, people have different cards for different things. Sometimes it's one card for petrol, one card for groceries, whatever it may be. If you've got a customer that isn't buying groceries on your card, you can't assume that they don't eat. They're obviously using your card for something else. I mean, they're using another card, they have an account somewhere else. So you then have an issue of you don't own that customer fully. You then want to get to the stage of how can we know them better to make the recommendation or get them to be fully onboarded with us as a customer and make us as a bank their top choice or front of wallet choice.
Yeah.
And 100%, there are a range of solutions that we offer that do that, starting to getting to know your customer with that limited information. So not having their view of their spend, but then starting small with that smaller picture that you have, the smaller data points, getting to know them. I think it's called dynamic experimentation or dynamic algorithms, where you start off with limited data, you then get to know them and interact and engage, and then eventually you grow that engagement to then get to the point where you know them and then can say, here's a product recommendation, how can we move forward and know this customer fully, have that full view, as you mentioned.